When we talk about cash flow, we talk about EBITDA. But let's back up a moment. And what is cash flow? Cash flow is actually the measuring of cash and determining where it ends up. Now, there are two types of accounting methods. There's what we call cash accounting and accrual accounting. Cash accounting is making all the decisions based on money that hits the deposit account and money where the check is written or wired. That is cash. With an accrual basis, when the money's earned but not received, it hits the books, even if it has not been received. And when expenses are incurred, even if the check hasn't been written, they reflect that in the books. That's called an accrual method. Cash flow is measured using an accounting firm called EBITDA, earnings before interest, taxes, depreciation, amortization. What they're doing is they're taking the net income and they're adding back the non-cash expense of depreciation and amortization. And because another business may not incur money for interest, they also add that as back to that equation. When we talk about closely held businesses, we talk about seller's discretionary cash flow. And the reason we use that is because a business owner can pull the money out of the business in many different ways. The obvious ways is you can pull it out as net income, or you can pull it out as salary. But the owner can also pull that money out in other ways. If there's common ownership, meaning the person who owns the business also owns the real estate, they could pay a higher amount of rent, goes to the real estate trust, and then the person pulls it out of that real estate trust. They'll do that to save themselves taxes. Another difference could be is if you have a family member working in the business. Let's say that family member is working in the business, and if it was a non-family member, you'd only pay that person $20,000 a year. But because it's a family member, you're paying that person $50,000 a year. The difference of $30,000, the $50 what's being paid, the $20 of what they're actually worth, is $30,000. That $30,000 is added to seller's discretionary cash flow because a future owner won't pay that person $50,000 for a $20,000 a year job. Other examples could include paying for a car that is overpriced, over exotic, or maybe it's just simply used for personal needs. Well, a future owner wouldn't pay for that car, so that would be added to seller's discretionary cash flow. Let's talk about credit cards for a moment. Now, the types of businesses that we sell tend to be professional businesses, B2B type businesses. Credit cards are typically not a factor. But because some people who do not own these types of businesses may be watching these videos for educational purposes, I want to talk to you specifically about credit cards. There are perks to being an owner. Everybody knows there are perks to being an owner. When you're selling your business, you can recover those perks if they're provable and documentable. However, when you put something on your credit card, let's say you're running personal expenses through your credit card, those are considered lost expenses. Those are to the buyer's benefit because nobody wants to sit through and go through 36 months or 48 months of credit card statements to pull up business expenses versus personal expenses. As a result, any personal expenses that are going through your credit cards are to the new owner's benefit. You're trying to capture all the different ways that the owner is pulling money from the business, either in cash or owner's perks. A seller's discretionary cash flow is the total money the seller could have put in their pockets if they had desired to.